Let me give you the specifics, because I know some of you are going to want to verify this yourselves. Good. You should. Never trust, always verify. Multiple Australian bullion dealers are now listing silver at prices that translate to approximately $120 USD per ounce. Some products are even higher. We're seeing premiums over spot that would have been considered absolutely insane just 6 months ago. And here's the thing. It's not just one dealer having a pricing error. It's not a website glitch. This is systematic across the Australian bullion market. The Perth Mint, one of the most respected mints in the world, has been dealing with unprecedented demand. Delivery times have extended, product availability has become sporadic, and prices have adjusted to reflect what happens when demand overwhelms supply. But wait, if you listen to the mainstream financial media, silver is supposed to be around $32, right? Maybe $35 on a good day. That's what the ticker says. That's what the COMEX futures contract settles at. So how is it possible that Australians are paying almost 4 times the official spot price? The answer is simple, and it's the key to understanding everything that's about to happen. The spot price is a fiction. It's a paper price. It reflects what silver trades for in a market where almost nobody takes delivery of actual metal. The Australian price, the $120 price, is the real price. It's what you actually have to pay to get physical silver in your hands. And that real price is now screaming a message that every silver investor needs to hear. The paper market has lost control. Now, some of you with a finance background are probably thinking, this doesn't make sense. Arbitrage should close this gap. And you're right, in theory. Here's how arbitrage is supposed to work. If silver is $30 in New York and $120 in Sydney, a smart trader should be able to buy silver on COMEX, take delivery, ship it to Australia, and sell it for a massive profit. Free money. The act of doing this would increase demand in New York, as pushing prices up, and increase supply in Australia, pushing prices down until the gap closes. This is Econ 101. It's how efficient markets are supposed to function. But here's what Econ 101 doesn't account for. What happens when the cheap market doesn't actually have the product? You can't arbitrage what doesn't exist. COMEX registered silver inventory, that's the silver actually available for delivery, is at multi-decade lows. We're talking about 30 million ounces backing a market that trades 800 million ounces of paper silver daily. Try to take delivery and see what happens. You'll get delayed. You'll get excuses. You'll get offered cash settlement at a premium rather than actual metal, because the metal isn't there. This is why the arbitrage is broken. The paper market is offering a price for a product it cannot deliver in size. And the physical market in Australia, in Shanghai, in Dubai, in Mumbai, is telling you what the metal actually costs when you demand real delivery. When arbitrage fails, price gaps don't close through market mechanics. They close when the fake price gets exposed and has to reset to match reality. That reset is coming for the US market. Australia just showed us exactly where the price is going. Now, I don't want you to think this is some isolated Australian phenomenon, because it's not. Australia is just the latest, and perhaps the clearest, example of a global pattern that's been developing for months. Let me take you around the world real quick. Shanghai. The Shanghai Futures Exchange has been showing persistent premiums over COMEX for months. We've seen prices equivalent to $130, $135, even $140 per ounce in USD terms. Chinese demand for physical silver has been relentless, driven by both industrial consumption and investment demand. India. Indian import premiums have been astronomical. India is the world's largest silver jewelry market and a major industrial consumer. They're paying whatever it takes to get metal because they need it. Premiums of $40, $50 over spot have become normalized. Dubai. The Dubai Gold and Commodities Exchange deals in physical metal. Their prices increasingly diverge from London and New York. Dubai has become a hub for physical precious metals, trading precisely because they deliver actual metal, not paper promises. Singapore. The Singapore bullion market has seen similar dynamics. Wealthy Asian investors who want allocated physical metal in secure vaults are paying premiums that reflect true scarcity. Do you see the pattern? Every market that deals in physical silver, actual metal you can hold, is pricing silver dramatically higher than the paper markets in New York and London. This isn't a coincidence. This isn't random. This is price discovery migrating from paper to physical. And once it migrates, it doesn't go back. So here's the million-dollar question, or I should say the $120 question. Why is the US market still pricing silver so much lower? The answer has 2 parts. Part 1, paper market control. The COMEX and LBMA have controlled global silver pricing for decades through sheer volume. They trade so much paper silver that their price becomes the reference point for the world. Miners price their output based on COMEX. Industrial users negotiate contracts based on LBMA. The whole system orbits around these paper benchmarks. This works as long as everyone accepts the paper price as legitimate, but legitimacy requires that the paper price at least loosely connects to physical reality. When physical markets around the world are screaming that silver is worth $120 and COMEX is saying $32, the legitimacy erodes. Fast. Part 2. The confidence game. Here is the dirty secret of the paper market. It only works if the majority of participants never ask for their metal. Think about it. If COMEX has 30 million ounces and trades 800 million ounces daily, they're running on a 96% confidence ratio. They're betting that 96% of contract holders will settle in cash, roll their contracts forward, or otherwise never demand physical delivery. That's a hell of a bet. And it's a bet that's starting to go wrong. Every time a headline says Shanghai silver at $130, some percentage of COMEX traders think, wait, maybe I should take delivery. Every time someone sees Australian prices at $120, a few more delivery notices get filed. It doesn't take 96% demanding delivery to break the system. It takes maybe 10%, maybe 5%, and we're approaching those numbers. When confidence breaks, it breaks suddenly. The paper price doesn't gradually adjust. It snaps to physical reality almost overnight. That snap is what's coming for the US market. Australia just told us when the spring is about to release. Now, I know some of you are thinking, okay, but has this kind of paper to physical price gap ever closed before? What does history tell us? Great question. Let me give you 2 examples. Example 1, 1979 to 1980. In the late 1970s, the Hunt brothers began accumulating physical silver. At first, the paper market barely noticed. Prices rose slowly while the Hunts took delivery of actual metal. But as physical supply tightened, something remarkable happened. Paper and physical prices began to diverge. The cost to lease silver spiked. Delivery queues extended. And then the snap happened. Silver went from $6 to $50 in a matter of months, a 700% plus move that caught almost everyone off guard. The people who saw the physical shortage early and positioned accordingly made generational wealth. The people who trusted the paper price got left behind. Example 2, 2020, physical premiums. Remember the COVID crash? In March 2020, the paper price of silver crashed to $12 per ounce. Panic selling in futures markets drove the price down dramatically. But something interesting happened. You couldn't actually buy physical silver at $12,000. Dealers were sold out. Mints stopped taking orders. And anyone who had physical silver for sale was charging $20, $25, $30 per ounce. The paper price said $12. The physical price said 25 plus. Sound familiar? That gap eventually closed, by the paper price rising to meet physical reality. By August 2020, silver was pushing $30. The pattern is clear. When paper and physical diverge, the resolution comes from paper rising to meet physical, not the other way around. Australia at $120 is telling us where the resolution is heading this time. Now, I know there are different types of people watching this video, and I want to address each of you directly. Type 1, the long-term stacker. You've been accumulating silver for years. You've endured the manipulation. You've watched the smackdowns. You've listened to friends and family tell you that you're crazy. Here's what I want you to hear. You were not crazy. You were early. And early is not wrong. It's just uncomfortable. Australia at $120 is vindication. It's proof that the physical market agrees with your thesis. The only thing that was fake was the paper price, telling you your stack wasn't worth what you knew it was worth. Hold your position. Don't get shaken out by volatility. The paper market is going to throw everything it has at suppressing prices as the endgame approaches. Let them. Every smackdown is a gift to accumulate more. Type 2, the recent buyer. Maybe you bought silver in the last 6 months. Maybe you bought near recent highs. You're watching the price bounce around and wondering if you made a mistake. You didn't make a mistake. You made a decision based on fundamentals that are now being confirmed by physical markets around the world. Here's what I want you to understand. Stop watching the paper price. Seriously, it will drive you insane and it doesn't reflect reality anyway. Instead, watch the physical premiums. Watch what Shanghai is paying. Watch what Australia is paying. That's the real price. And the real price is telling you that your silver is worth far more than COMEX says. Your job now is simple. Hold, add on dips if you can afford to, and wait for the US market to catch up to physical reality. Type 3, the skeptic. You're watching. This thinking, it's all hype. Silverbugs have been saying this is the year for decades. Why should this time be different? Fair question. Here's my answer. This time is different because of one thing. Geographic price divergence at this scale is unprecedented. Go back and check. Find me another time when Western paper markets showed silver at $32, while physical markets in Asia and Australia showed 120 plus. You won't find it because it hasn't happened before. The fundamentals have always pointed toward higher silver prices. What's changed is that the mechanism of suppression is breaking in real time, and physical markets are proving it by paying 3 out of 4x the paper price. You don't have to believe me, just watch. The gap will close. And when it closes, you'll understand why some of us were so convinced. Let's talk about who benefits from this situation. Because price suppression doesn't happen by accident. It happens because powerful institutions profit from it. The bullion banks, JP Morgan, HSBC, Bank of America. These are the primary market makers on COMEX. They hold massive concentrated short positions in silver. Here's the game. They sell paper silver contracts they can't back with physical metal, to suppress the price. As long as nobody demands delivery, they pocket the profits from the artificial price suppression. JP Morgan has been fined almost $1 billion for precious metals manipulation. Not allegedly, proven. They admitted to it. And yet they continue to operate as if nothing happened. Why? Because the fines are a cost of doing business. When you're making billions from manipulation, a $920 million fine is just overhead. The Federal Reserve. This one's indirect, but critical. A rising silver price is a vote of no confidence in the dollar. Throughout history, precious metals have been the thermometer for currency debasement. The Fed has every incentive to keep a lid on gold and silver. Not through direct trading, that would be too obvious, but by tolerating the manipulation that bullion banks conduct. It's a symbiotic relationship. The banks make money from suppression. The Fed gets to pretend the dollar is stable, and regular investors get robbed of the true price discovery they deserve. The short sellers, who are trapped. Here's where it gets really interesting. There are traders and institutions who have been short silver for months or even years. They were betting on the paper price staying low. As physical markets diverge, these shorts face a nightmare scenario. They're short a product that's becoming impossible to source. If they get called on their positions, they'll have to buy physical silver at whatever price is available, which is currently $120 in Australia. These trapped shorts have every incentive to keep the manipulation going as long as possible. Because when it fails, they blow up. You know, I have to take a brief moment to check in on our favorite contrarian indicator, Jim Cramer. For those not familiar, the inverse Cramer strategy is simple. Whatever Jim Cramer recommends, do the exact opposite. This strategy has been backtested and shown to outperform most professional money managers. The man has a supernatural gift for being wrong at precisely the moments that matter most. If wrong calls were an art form, Cramer would be hanging in the Louvre. As of my last check, Cramer remains lukewarm to bearish on precious metals. He's still talking about the overheated gold and silver trade, still suggesting there are better opportunities elsewhere. This, frankly, is one of the most bullish signals I can imagine. Cramer's dismissiveness of precious metals during the biggest bull market of our lifetimes tells you everything you need to know about where mainstream financial media stands. The day Cramer turns bullish on silver, like genuinely enthusiastic, is probably the day to take some profits. Until then, his skepticism is confirmation that we're on the right side of this trade. All right, moment of levity over. Back to business. So let's get specific. Where is U.S. silver going and when? I want to be clear, I'm not a fortune teller. Nobody can give you exact prices on exact dates. But I can describe the structural setup and what it implies. Phase 1, acceleration of delivery demands. Current. We're in this phase now. More and more COMEX contract holders are standing for delivery rather than settling in cash. Each delivery drains registered inventory further. As Australian and Shanghai prices scream higher, the incentive to demand COMEX delivery increases. Why settle in cash at $32 when you could take metal worth $120? This phase creates pressure but doesn't yet break the system. Phase 2, delivery failure or force majeure, 1 to 6 months. At some point, and I believe it's closer than most people think, COMEX will face a choice. Either admit they can't deliver metal to everyone who demands it, or find some way to force cash settlement at prices below physical market rates. Either option destroys confidence in the paper market. Once traders realize the paper price is a fiction, the game is over. Phase 3, price reset to physical reality, following Phase 2. When the paper market loses credibility, price discovery shifts entirely to physical. The US price resets to match what Australia, Shanghai, and Dubai have been telling us all along. What does that price look like? If we use Australia as a guide, we're looking at 100 plus silver in the US. If we use peak Shanghai premiums, possibly $120, $140. And remember, that's not the top. That's just the reset to physical reality. From there, true supply-demand fundamentals take over, and those fundamentals point significantly higher. My specific targets. Near term, 1-3 months, US silver breaks $50. possibly $65 medium term, 3 to 12 months. US silver reaches $100, $120, matching current Australian prices. Long term, 12, 24 months. Silver reaches $150 $200 as true price discovery occurs. These are not guarantees. They're structural implications based on the current setup. The actual path will be volatile, with sharp pullbacks that test everyone's conviction. Which brings me to the most important section. Let me give you a clear action plan based on everything we've discussed. Action 1, physical over paper, period. If my thesis is correct, if the paper market is losing control of price discovery, then holding paper silver defeats the entire purpose. SLV, it's custodied by JP Morgan, the same institution fined for silver manipulation. PSLV, better but still paper. Futures contracts, you're playing their game on their turf. Physical silver, in your possession or in allocated storage with a reputable vault outside the banking system. This is the only way to ensure you participate in the repricing. Action 2, ignore COMEX price volatility. Seriously, stop watching it minute by minute. The COMEX price is increasingly disconnected from reality. It's like watching a fever thermometer that's been stuck in ice water. It's not measuring the actual temperature. Watch the physical premiums instead. Watch what Australia is paying. Watch what Shanghai is paying. That's your real-time indicator of where value actually sits. Action 3, buy the dips. Don't panic on the dips. There will be smackdowns. The paper manipulators aren't going to go quietly. They're going to throw everything they have at suppressing prices as the end game approaches. Let them. Every smackdown is a gift. Every panic sell-off by weak hands is metal transferring to strong hands. If you have dry powder, use the dips to accumulate. If you don't, just hold. The worst thing you can do is sell physical metal during a paper-engineered smackdown. Action 4, think in ounces, not dollars. Stop measuring your wealth in a unit that's being debased. The dollar is losing purchasing power daily. Measuring your silver stack in dollars is like measuring your height with a ruler that shrinks every year. Your stack is worth what it's worth in ounces. Your goal is to accumulate more ounces. Whether you buy at $32 or $40 matters less than whether you buy at all. Action 5, prepare for volatility in a longer timeline. This isn't a get-rich-quick scheme. The reset could take months. It could take a couple of years. The structural forces are clear, but the timing is always uncertain. Make sure your physical silver is in a secure location. Make sure you have other financial needs covered. Don't over-leverage into metals at the expense of liquidity you might need. This is a marathon, not a sprint. Position accordingly.